Hey, I'm Ben from Modern Graham, and today we are going to talk about the Scott's Miracle-Gro company. This is a very interesting company that I think you will be interested to see how I value it, so stick around. Now, what we're talking about, like I said, is Scott's Miracle-Gro company. Ticker is SMG. The current price is $43.34, and it is agriculture. And I think we all know that it does fertilizer. That is their biggest product, or most well-known product, I should say. Balance sheet. These are the figures that I find most important from the balance sheet, and they will all play a role in the valuation to come. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. So those will all play a role. Now, earnings per share. Looking at this chart over here, we have in blue is the earnings per share that went up, then came back down, then have been kind of on the rise, came back down in 2017, and have been super high compared to previous years, the last few years. And now the 2021, it was negative. So now looking at estimated for the current fiscal year, it is negative. That's a big change from where it was. Looking over here, we have earnings in a table where we can see the details of that chart. And we can see the last 25 years of, oh no, this goes all the way back, 30 years. 30 years of earnings here. We have negative there and negative in 2008. Those are the only two that have been negative. Then we have the earnings per share Modern Graham, which is a weighted average to try to smooth out some of that business cycle. So when we have a low earnings year like 2018, the weighted average is a bit higher. Or if we have a high earnings year, then the weighted average is lower to try to smooth that out. Because you are a long-term investor, you care about what the long-term prospects are. And this helps determine some of that. So what I do is I take a 5-year average of the last 5 years, and I put the most weight on the current year and the least weight on 5 years ago, and that is how we get the weighted average there. Dividends, on red on this chart, you can see they have mostly grown, and that is good to see. So we have here details on the dividends. As I said, they have mostly grown during the financial crisis in 2008 and 9. They didn't really grow then, but since then they have grown every year, which is good to see. And the dividend payout ratio in 2018, when their earnings took a big hit, they kept that dividend growing. And so that dividend payout ratio was really high, which is a promising sign for if they are going to do what they can to keep the dividend high or keep that dividend growing. If they can absorb losses on the earnings and still pay out that dividend, then that is a good thing to see. Stage 1 of the valuation is to determine if the company is suitable for the defensive or enterprising investor. The defensive investor is somebody who is not willing to do a lot of research into individual companies, and so they must have stringent requirements for whether or not a company is suitable for them. So the first one is the market cap. It has to be over $2 billion. In this case, it is $2.4 billion, so we have a pass there. Current ratio must be over 2. Here it is a 2.42, so we pass that requirement too. Earning stability. The current estimate is not factored in here. So right now it passes for the defensive investor because it has 10 years of positive earnings. We give them the benefit of the doubt that they might turn it around before the end of the fiscal year, and maybe we'll keep that. But if not, then that would be a fail in the next update. Dividend payments for 10 years prior, they pass that. Earnings per share have to have grown at least by a third in the last 10 years. It has definitely done that. It has over doubled since then. So it passes that. And PEMG, the price to earnings ratio, has to be under 20. Right now it is 9.33. And the price to book has to be under 2.5. It's not here. It's 5.74. Or the price to book times the price to earnings ratio has to be under 50. That one doesn't pass either. So we get a fail. So right now, this company gets 6 points out of 7 for the defensive investor, which is enough to be suitable there. Enterprising investor, this one is by default suitable for the enterprising investor because it is suitable for the defensive investor. The enterprising investor is willing to accept companies that might not be otherwise suitable because the enterprising investor is willing to take the time to do even more research into the company. Current ratio for the enterprising investor has to be over 1.5, passes that at 2.42. Debt to net current assets have to be under 1.1. It fails that with a debt ratio of 2.08. The earnings stability, it has to have positive earnings for 5 years. It has done that. It pays a dividend, so it passes those two tests. And it has to have grown its earnings from 5 years ago, and it passes that too. That is the weighted average, by the way, so it is looking at that. So right now, again, it would be suitable for the enterprising investor, even if it doesn't pass for the defensive investor. Though if the reason it fails in the next update for defensive investor is because of that possibility of a negative earnings this year, it would fail for the enterprising investor as well. So pay attention to that. Now, stage 2 is a determination of intrinsic value. So if you've determined that the company is suitable for your particular investor type, the next step is to look at the value. And remember that what Mr. Market, that's the market, values the company at is, or what they price the company at, is not an indicator of what the company might actually be worth. That is the intrinsic value. And to calculate that, we take the formula from the intelligent investor, which is value equals earnings times 8.5 plus 2 times the growth rate. And I use the weighted average earnings there. That's why I call it the modern Graham value formula. So we have two variables to figure out, earnings and growth. Earnings per share, like I said, is a 5-year weighted average. This year, it is 4.64 using the estimated figure for the year. We plug that in to here where we are calculating the value. And growth, we take the current weighted average, weighted earnings, and the 5 years ago weighted earnings. Total growth there was 61%. Divided by 5, we get a growth rate of 12.25%. Then we put a safety margin in because growth is a key variable in the formula, and any difference in growth has a big impact on the value. So that is where we have a safety margin. We have a growth estimate of 9.2%. So then we calculate a value of $124.86, which based on the chart here, you can see that the current price of $43.34 is much lower than the current value of $124.86, which gives it an undervalued opinion. If you were to put a 3% growth rate on the company and use the formula, you would get a value of $67.33. And if you put a 0% growth rate, you get a value of $39.47. So then if we're looking at what the market is implying and we put price in place of value and then solve for growth, the market is saying that they believe this company will grow at 0.42% in perpetuity. If you think it will grow more than that over the long term, then that would be another indicator that this is undervalued. That is one way of looking at that market implied growth rate. Now, looking at the grade, this is another way that I look at different companies and use it to compare them from one to another. Investor suitability, it is suitable for the defensive investor, so it gets 2 points. Good price to value, it is undervalued, so it gets another point. Is not trading below its Graham number. We'll talk about that in a minute. It has not grown dividends for 20 years or more, so it doesn't get a point there. It is trading at a higher than 2% dividend yield, and it has a PEMG below its industry average, so a total score of 4 points, which on the chart is a B+. Now, I will note that, again, if it has a negative earnings year, and that makes it fail the earnings stability tests, this one would drop 2 points because it would not be suitable for either the defensive or the enterprising investor. And that would put it at 2 points and give it a grade of C. So a lot is at stake. That is a key part of making sure that you have a good company that you're looking at is earning stability. And this one right now looks good, but you might want to pay close attention to it. Put it on your watch list if you're a little bit hesitant at this point. Stage 3. If you have decided that you want to go forward, then now is the time to do further research to determine if it's suitable for your individual portfolio. I can't decide that. I don't know your portfolio. I'm not a registered investment advisor. I'm just giving my opinion on this company. And you need to do further research to determine if it's good for you. Net current asset value. That is a floor. If a company is trading below this figure, it is a golden opportunity potentially. And in this case, it's not. But that is one thing to keep in mind. Graham number formula. This is derived from taking the requirements of the defensive investor and putting it into a formula, or like creating a formula to try and have an easy way of looking at it. In this case, the Graham number is 0, so it is not trading below its Graham number. This one uses the estimated earnings per share, and that is negative, which is why the Graham number is 0. Price to earnings ratio, using the weighted average, we get a PEMG of 9.33. Current ratio, other useful information here. The current ratio is 2.42. The price to book ratio is 5.74. And the dividend yield is 6.12% with 13 years of consecutive years of dividend growth. Those are all good to see. Now, if there's something more you want to have, more useful information that you'd like me to include in this part of the discussion, then leave a comment in the comments below, and I will look to see if I can do that. Moving on to stage 4. So we are looking at the stock chart, and a lot of people may question, why is a value investor looking at technical indicators? Well, the answer is because if you've gotten this point, or to this point, and you've decided that you want to put this in your portfolio, the next step is to try to time it right so that you are maximizing your profits. We don't pay attention to Mr. Market when it comes to determining if a company is valued well. We pay attention to Mr. Market when we're trying to find our entry point into the market. And this one, it's interesting. If we go way back to 2021, that is when the company was at a maximum, and then it started to come back down. And it had a couple of different things happening. Over time, we started to see towards the end of the year, a trend, an upper trend line developing here and a lower trend line developing too. And it's been pretty much inside those margins and coming down. Now this red line here, there's a level of support at about 39.40 or so. That goes way back. I had to go way back here to 2012 where that support level was established, and that came about because the company traded above that figure for a long time before starting to move up. If it does, we're going to move back to the current time here. If it does fall below that, then the next level is even lower at 1866. So there is potential that this one could fall farther before it's time to enter, but it also could be at the bottom. This level could be the support level, and we could see it test that trend line, and if it breaks above that, that could be a good indicator that this one is on its way up. So pay close attention to that, and click on the video on the screen now. That is a list of other high-yield dividend stocks that you might be interested in. This was one of them on the list. There are 9 others, so click on that video now, and I will catch you next time. Take care.